Places, please. Quiet down. And here we go. And roll camera.
Okay, hey everyone, David Starr here as we kick off a session that was requested. It was asked that I spend a little bit of time talking to y'all today about the April jobs report that we got last Friday. What these are, why we care about them from a macroeconomic perspective, and why we care about them as traders. And look, as technical traders, we probably don't care about jobs reports all that much. We care about the charts, but in order to know what to look for on our charts and when to look for it, we need to know when certain economic reports matter. So let's go ahead and just look at some of the results that we had here on Friday. Right, I track economic events here through Forex Factory, and we can see what was reported by the Bureau of Labor Statistics on Friday, and this is not all of the data that we get. It's actually a huge report with lots of detailed information, which economists pour over in a decent amount of detail. But the summary here, right, we had an unemployment rate of 3.9%, a little bit higher than the 3.8% that was expected, right? We had an addition to non-farm payrolls of 175,000 workers. So less than the 238,000 expected. And notably, the average hourly earnings, right, increased less than expected, 0.2% versus 0.3%. Now, in some environments, this would be considered a report that isn't all that great. In this environment, where the one thing that matters most is when we get a Fed rate cut, this is a good report, right? This is something that I like to refer to as Detroit Lions syndrome, this idea that that you actually want to underperform to get a good draft pick, right? Now, I know that's not the current Detroit Lions, but I've referred to it that way for a decade or more, and so I will stick with it, right? This is the idea that we want, quote unquote, bad numbers for the FOMC to cut rates. So why... let's step back. What we've always got to focus on when we focus on news is we need to understand what the market is focused on. We get a ton of news reports every day, economic reports, and some of them seem to not matter at all. And it's all based on what the market is keying off of. Now, I have no idea how long we have to go before we get, for example, a trade balance report. We get them once a month. If you go back to the 80s, when everyone was fussed about how U.S. industry was dying and everything was being taken over by the Japanese, and we ran a huge trade deficit, and that was the major thing affecting the economy, everybody waited for that report, and it was the major driver, right? Now, nobody barely even looks at it. Look, there were reports that we didn't look at a few months ago that now everybody looks at. The quarterly refunding announcement that we got last week. Nobody looked at that last year. But when everybody's concerned about how much of different denomination debt the U.S. government is issuing, all of a sudden it matters. Because last quarter, we got a number that surprised people, and and we got a huge move in the market. So it's all keying off of what the market is keying off of, and that's what people watch. So we will get a CPI report, I think, next week. That's going to matter, and everything matters because of the Fed. So from a macroeconomic perspective, right, and the macroeconomy is just aggregate or the study of aggregate supply and demand, right? When we focus on microeconomic factors, we might be focused on, I don't know, MongoDB as a company and how they're doing and what demand looks like for their product, right? Whether, how much of that demand goes to them versus a competitor, I don't know, Oracle or another database manufacturer, maybe some free stuff. That's always competitive. Right? Those are going to be microeconomic studies. Macroeconomic studies are going to be anything that affects, right, aggregate supply and demand. That is, how much stuff is going to be bought and sold in total across all sorts of broad categories. And one piece of that is going to be how robust the economy is. Right? So on the one hand, we're gonna want a robust economy for the stocks of companies that we're interested in to go up, right? If everybody is buying more stuff, then companies in total will do well, their stocks will do well, and everything will do great. When our main concern is how robust the economy is, and it isn't right now, that is, it isn't a concern because the economy is robust and people see it that way. Nobody is all that concerned about a bad jobs report. Now, if we get a huge string of bad jobs reports, really bad ones that indicate that we might be in a recession and companies will do more poorly, then all of a sudden nobody wants a bad jobs report. If you were trading, right, 2008, 2009, we kept getting bad jobs reports and people were just waiting and waiting and waiting for us to start getting good jobs reports for the economy to do better, to think that we were starting to come out of a recession and then we could buy stocks again. It was a totally different reaction than we're getting now. So the first thing to realize is that there is not any one single reaction to a jobs report. It is not always that good is good and bad is bad, and it is not always that good is bad and bad is good, right? In this particular environment, like I said, it is all about the FOMC. And the reason that it matters is because or the jobs report matters, is the transmission mechanism between jobs and inflation, right? Or at least that's one of the key drivers. And this linkage between jobs and inflation that we care about is the wage price spiral, right? That is, if everybody is making more money and companies need to pay people more money, then corporate costs go up. Corporations need to pass that on, right? So all of a sudden consumers need to pay more for things. And so consumers turn around and say, we need a raise to pay for all of that stuff. And it just keeps going around in circles as a self-reinforcing sort of thing, where higher wages drive higher prices drive higher wages. So that only matters. That only matters if we've got relatively low unemployment, right? So if we go back Friday, right? 3.9% unemployment, a little higher, but still relatively low. And there are lots of indications that the labor market is still rather tight, that there are that there, particularly for certain jobs, there are relatively few people to fill them. So in that condition, right, employees have the power. And if employees have the power, then they have the right to sort of insist on that additional rate, right? Additional salary, additional hourly rate, whatever it happens to be. So first of all, we're in a situation where that can happen. If everybody wants a job, they're not worried so much about making the most from a job. They're worried about, do I have one or not? Right? Totally different environment. So we've got the tight labor market, which can and will drive up prices and lead to inflation. So that is one of the concerns. Of course, that highlights that there is this tension between employment and inflation, and that leads to the Fed's dual mandate, right? That is, unlike most central banks, which only are required to create stable prices, the Fed is required to create stable prices and maximize employment. So while stabilizing prices might usually come at the expense of employment, right, the Fed has to balance both. So the two things that are going on here is that in order to lower rates, the Fed needs a few things. First, they need to be free to lower rates, right? That is, they need to see that inflation is under control. Now, the last few inflation reports that we've got haven't looked all that great. They've come in hotter than those looking for rate cuts would want to see, and lower or coming in worse than we would expect if the Fed was prepared to raise rates. So while the lower employment numbers don't tell us that inflation is going to come down, they're at least telling us that some of these wage pressures may be abating, and that could be one of the factors that allows rates to come down, right? That is, it's been a surprise that the labor market has remained as strong as it has since the Fed started raising rates, but maybe we're starting to finally see some of this trickle into the economy. So I want to be clear. This is not saying all of a sudden the Fed can lower rates, but we're starting to see a little hint of encouragement, and that was enough for the market to jump up. So what do we need to see? Well, the Fed has said they want to see more evidence, right? So that means 1 week employment report isn't going to do it, but it's the sort of thing where if we continue to see the labor market getting a little looser, then that will help. They're also probably going to want to see it corroborated in the inflation reports, right? In the CPI, in the PCE, and notably the core CPI and the core PCE. Nevertheless, if you need, let's say, 3 weaker reports in a row, right? I'm making this up. We don't know what the Fed's looking for. People argue about it all day long. But if you need 3 in a row and you want to get in before the move in the market, then you buy when you get one good report, right? Because you don't want to buy after the third. It's all about these shifting odds. Now, if you're a technical trader like me, you're not buying, you're not sitting there saying, I need to see, this from a company report in order to buy the company. I need to see this from an economic report to buy the market as a whole. You're looking for technical indicators on a chart, but you want to know when we have a situation that is set up for a volatility event. And so you need to know, and you probably knew already, right, that that the market was keying off of the jobs report, and you probably knew already that that the market is not all that fussed with trade balance reports, right? So it shouldn't be a surprise that we could get this size move here on Friday, the gap up that we got. It might have been perhaps a surprise that it was as what direction it was. We didn't know what the report was going to be, and in fact, the report was a bit of a surprise. But that's of course why it matters, right? Why we care about it. Now, why do we care? Why do equities care about having lower rates that maybe we start to get from the Fed? Well, 2 reasons. The first is just easy money leads to more consumption, right? This idea of aggregate demand. And easy money means that aggregate demand likely will be higher than if money was tight, and that is good for all businesses. That's piece number 1. Piece number 2 is that is this idea that you may have heard that growth stocks in particular, and you may hear this expressed as technology stocks, do better in a lower rate environment. So if you've always wondered why do technology stocks do better when rates are lower, it's simply this. Most technology stocks are growth stocks, right? That is, most technology stocks are stocks that people own because the company is going to do more business next year than they do this year, or people at least expect or hope that, and even more business the year after that, right? They keep inventing new things. Those things get slowly adopted, and as they get adopted more and more, the company does more and more business. So again, if you're a technical trader like me, you look at these patterns on the chart and you decide when you want to buy and when you want to sell. But we are doing our buying and selling in a market where participants value things a lot of different ways. And one of those ways is by trying to assess what a company is worth based on how much money it's going to make. And if you think they're going to make money next year and the year after that and the year after that, the typical way of valuing a company like that is through a discounted cash flow model, right? That is the idea that money that you make next year is not worth quite as much as money this year. And the amount, the difference between what it's worth next year and what it's worth this year is the interest rate, right? So you take whatever the prevailing interest rate is and you take money that you might earn next year and you discount it by that interest rate. And money from the year after that, you have to discount twice, right? So money from 2025, you have to discount by some interest rate to figure out what it's worth in 2024 dollars, and then discount it again for 2023 dollars. So the overall point here is that if you've got some high-flying tech company that's not even profitable right now, that's going to make most of its money 5 years from now, but people are still buying it, they're buying it based on way out in the future and an amount that has to be discounted a lot. If you've got a large, mature company that is growing slowly and they're already worth a lot today, yeah, you're still going to discount the future cash flows, but not as much. So the point is, people valuing stocks based on fundamentals are going to consider growth stocks to be right to be even better, even more valuable if interest rates decline. Now, you don't need to be a fundamental investor to make use of that. If you know the general idea, if you've observed in the market that these things go up as rates go down, you know how to deal with that, right? You buy them when rates go down. So that's what everybody's focused on. We know it, and we know that creates a regime, particularly for the jobs report, where bad news is good, just like it was on Friday. As long as it doesn't get too bad, as long as it doesn't look like it's starting to go negative and the fundamentals of the economy start to decline. And if that happens and happens to a degree that causes people to think that that overall aggregate demand is falling rapidly, then we'll still remain in this bad news is good environment. So let's see, question here. Do I think that the Fed rate cut announcement is a signal of the stock market going up? So here's the thing. Tops are always made on good news, right? There is a point when you finally top out. It comes on good news. You make all-time highs on good news, and then there comes a point where things start to deteriorate. So especially if the Fed rate cut announcement comes as a surprise, we will definitely go up, right? If it is fully expected, it could be the sort of thing that gets a quick move up and that it's faded, right? So, but yeah, I certainly think when we get our first rate cut announcement, the initial reaction will probably be a move up. The question is, will it be faded? Now, there's as to what happens afterwards, as I mentioned, I watch patterns, right? So whether I will fade it, right? Whether I will look to take profits on a move up on a rate cut announcement will depend on context, right? Where are we in the patterns? Are we at a new high? Are we at fib extensions? Do we have a pattern into those highs that looks complete? So good question, but I can't answer it for sure right now, right? So, if we look at what the market's pricing in, we can certainly see that, if we just bring up the CME Group FedWatch tool and take a look at that, right? So we're sitting here, when we get out into September, right? We're, at least right now, right? at least right now, and since Friday, the market is pricing in at least one rate cut here at the September meeting, right? So 49.3% odds of one rate cut. Remember, there's still a 30% chance of none, but if you add to that 49%, another 19% chance of two cuts by September, at least the odds are slightly in favor of at least one cut. If you go back to July, right? We have a June meeting. Odds are even worse in June. In July, odds are still in favor of holding, and that's what the Fed has told us to expect, right? They told us, hey, we need more evidence. There hasn't really been much evidence yet, and so that's kind of why we're stuck here. If we go out to November, at that point, right, only a 20% chance of staying pat in November. And again, if the employment report stays weak, if core PCE, core CPI both continue to come in, then I think we'll see something around those times. Now, if we're heading into a July meeting and the odds of a rate cut in July are 30% and we get a rate cut, we will jump up considerably. Right? But it all depends on the path there, what equities have done between now and then, and everything else. Right? Now, why core PCE and why core CPI? Great questions, right? Because I always hear this. Why does the Fed care about core? Why do they care about excluding food and energy? Everybody has to pay for food. Everybody has to pay for energy. Why does it matter? And here's why it matters, because it does matter, right? And here's why you can ignore those folks who like to sit on the sidelines and throw rocks rather than get in the game, is not because it doesn't have to do with what people pay, but because the Fed has a job of controlling inflation, right? Of trying to make sure that prices next month are not significantly different from what they are this month. Right now, the difference is greater than they would expect, but it comes down to this, is that what economists have realized from studying this for a very long period of time is that if you include food and energy, current inflation doesn't tell us a whole lot about what future inflation is going to be. Whereas if you look at the price of everything else, that's a much better indicator of what future inflation is going to be. So if the core rate is high, that's a warning, right? That's a warning that we've still got an inflation problem and are much more likely, if nothing is done about it, to have high inflation next month, right? So there's a simple reason why they look at it, not because people don't pay for it and not because the economists don't know that people pay for it, but because it's an indication that something needs to be done. Right? So Taz, I wouldn't say that inflation can be calculated by the percentage of new money that's printed, but we do know that the general trend, right, that if you stimulate demand by making capital cheap, that prices are going to go up more than they would otherwise, right? So we certainly know that throwing capital out into the world has an impact of rising prices, right? So, in any case, I hope you all found that useful. I imagine that most of you know it, but the main thing for all us technical traders is just to know which of these reports matter, and we know that the jobs report matters, and to have a general idea of whether good is good or good is bad. And at the moment, we're still in an environment where good is bad. Anyway, that is my time, folks. I will be back here infrequently when folks have thoughts that they want to explore that I may be able to be in a position to talk to you about. Of course, I'm always in the Voodoo Mastery every day for those of you who want to catch up on some of the trades I do with Henry. And until I see you next, as always, good trading.
Is it all over, Rock?
I guess so.